Hello, we are recording live from the trade desk with this case study update. I'm Jeffrey Beamer. So today we're updating our Deere and Company collar. This is a position that we adjusted just a couple of days ago prior to earnings in anticipation of this event. And the stock has really moved in our favor in a big way. The stock, after closing at $77 yesterday, right around 77, the stock has gapped up over 13% today. This is a big move for this stock. Touched $88 before settling off of that, just around 87.32. We are going to make an adjustment to our collar, which is now just a synthetic call. Remember, we took off our short calls the other day. That did work in our favor, and we can now roll up our puts to help lock in our profit for now. Okay, that might not be the case going down the road as we continue to make adjustments, but for today it's going to look pretty, as I'll show you here in just a moment. But before we leave this chart, let me just take you through our prognosis for this stock. All right, so the stock has come up and touched 88, as I mentioned. This is matching the similar high that was reached back in June. At that time, the stock reached this level, traded up here for 3 days before selling off. And I don't think that's going to happen again. My prognosis here is for the stock to now, before I get to that, we think about what's going to happen here. A couple things. And for those of you that have been around for a while, you know that pretty much anything can happen. Now, some of you may think, uh-oh, we've reached an area of resistance here, okay, which we have, and so we're immediately going to sell off and we're going to trade lower. Others of you with experience might realize, hey, the stock gapped up, maybe even on significant volume, which I don't have up here at the moment, but we'll show at a later time. And the stock could continue to push higher, which definitely could happen. My prognosis here is for the stock. I think the stock will take a break here. We'll trade sideways, possibly even forming what's known as a flag pattern. Okay, so that would look something like something like this. Sorry, took a moment. Just trade in a little bit of a zone here around this level. Don't know for that for sure, but just experience tells me that's a possibility. Now, that's not what's happened before, but we'll see. All right. So that is my prognosis. So let's go over to the trade and see where we are. The stock did gap up and move higher. Now, what we have here is a situation where we need to roll our puts up. All right. We did lose money in the put, but that's okay. We made money in the stock, which is reflective down here in our profit. We're actually up, if we use a cash basis, which is the basis we're using here for our case studies, we're up 11% in our position. And take a look at this on a risk of $615. All right, that's actually return on risk of over 100%. Okay, return on risk of over 100%. Many people trading collars kind of lose this point of view. I had very less, even though I had invested on a cash basis over $7,800. I was only risking $615 in the position. Okay, that's something that can really allow me to sleep at night and sleep comfortably. So what we're going to do, as I mentioned, is we're going to roll up our hedges here. We're going to roll them up to a level and protect our profits. And again, we trade these collars dynamically, not passively. Okay, we don't just make the trade and wait. We're going to trade these dynamically, and we're going to see the benefits of that actually right here in just a moment. So let me jump over and show you the adjustment. Well, first of all, let me show you what's happening with the options themselves. This is pretty interesting. The first thing I want you to note is that September is somewhat unique in that we have 5 weeks of options. Okay, so if you like to trade weekly options, September has 5 weeks of them, just how the calendar falls during, well, many years actually. So we are looking at week number 5 here because it does offer us 42 days, and if we're going to sell some premium, This, the around that 45-day level, somewhere between 30 and 60. It will vary. It is situational, but that's where you'll notice that we do a lot of premium selling right in there. And so we also do a lot of buying in that area too, for a couple of reasons, and we'll get to those reasons down the road. All right. But these are the series that we're looking at, are the September week fives on Deere. And our particular uh, chain here does show a 1 standard deviation move. That's where the color changes on the strikes. But I'm looking at these 80s. It's close enough to 1 standard deviation move. That's the most likely move that the stock is going to make over the period. And here's what I was talking about a little earlier. Notice the spreads have really widened here. This is unusual given that we've had such a drop in volatility. The spread here, as you can see, is, what is that, 30, a little over 30 cents. Um, Pretty big considering that's not common for Deere. Um, you'll also notice that these options don't have a lot of open interest. I'm not too worried about that because, well, as you can see here, just on the move today, 49 contracts were traded at this level. Take a look at this down here, the 85s. There was 0 open interest prior to this, and now 86 traded. So volume will come into these. So we're not really worried about that for right now. But this, yeah, most of the time we don't trade thin options, but we do know that volume will come into these, so I'm not too concerned about it. So let's show the adjustment here. Let's just quick review. The two colors here represent kind of a closed out position. All right. So originally we had bought the September 7250 puts. We are buying those back. We're going to offer the model price for these is a nickel. We're gonna, the mid price is 11 cents. We're gonna actually ask for 10 cents for these, which is right here. And the same thing on the puts that we're buying. And we're looking at buying the September week number 5 80 strike puts that have 42 days left to expiration. And we're going to offer up 70 cents for those, which you can see the model quote is 71 cents. We're going to offer just below that to see if we can get some takers. Again, these wide bid-ask spreads, the way to control those is through the use of limit orders. All right. You don't have to go chasing the price around. You just model what you want to either buy or sell your option at, put your limit order in, and make the market come to you. So in this case, I'm pretty much just telling the market, hey, here's my price, come meet it, come through it, so that I can get filled on this particular order. All right, so that's what we're looking at. Now let's look at the chart, and this is where it gets really, really kind of cool. You'll notice that right now, by making this adjustment, look what happens to this risk graph. It jumps over to the right-hand side of the 0 line. Now that's a little hard to see, but let me jump back to the trade before the adjustment, and you can see here where we had our risk. Okay, we had about a little over $600 in risk. Okay, not 7,000, just 600. And now with this adjustment, by rolling up our puts, take a look at this. We're actually locking in those profits. So if for some reason the stock tomorrow got cut in half, all right, and is trading at $43, well, we would still make a little over $74, almost $75 profit in this position if the stock got caught, cut in half. Who knows? Stranger things have happened when trading stock. All right. So in summary, this is the adjustment that we're making today. We're buying to close the September 7250 put. We're selling to open the week number 5 80 strike put for that roll. So we're not only rolling up, but we're rolling out. Okay, so this is a diagonal spread Okay, we're rolling out by 2 weeks to week number 5, and we're doing that for a debit of 60 cents. For a debit of 60 cents, and it really improves our position. The idea here is to take this risk graph and keep pushing it out to the right to where we're just locking in more and more profit. It takes time and it takes some adjustments, but we'll do it and you'll see how it happens over time. So once again, in conclusion, rolling up those puts from the September 72.50s to the September week number 5.80s for a debit of 60 cents. That's our case study update for today. And oh, one last note, we're not selling calls right now. We typically we would sell options into a move like this, but we're not. And the reason why, just in conclusion, is that the call side hasn't opened up yet. You can see we just come up to the 90s. I mean, calls or puts. We're only up at the 90s. We probably will get 95s and 100s here in a few days, so we'll come back and revisit that when those options do come available. But I would look at selling into this rally, all right, which is how a true professional does do it. All right, that's our case study update for today. I hope you found it of interest. Thanks for listening, and we'll talk to you soon here from the Trade Desk.